Welcome back to Griffonomics, where we conduct financial investigations to define the risk before we look at the reward. Today, we're diving into Strive, Inc., ticker symbol ASST.
And this is a fascinating one.
It really is. If you've been following the world of corporate finance, you know that the discussion around corporate Bitcoin treasuries has it's moved far beyond just buying and holding.
That's the Generation 1 model. Strive is something else entirely.
Exactly. Strive has positioned itself not just as a holder of the asset, but as this complex financial machine. It's engineered to leverage centralized control and specialized investment strategies to fundamentally outperform passive Bitcoin exposure.
Right. It's an active strategy, not a passive one.
We've taken a deep dive into Strive's intricate structure, pulling apart their recent merger filings, dissecting the complex preferred stock prospectuses, and analyzing their operational disclosures.
And what you find is a blueprint for something.
Well, radical asset consolidation. It's a high-stakes experiment in capital allocation that hinges on leveraging a single source of power. It's a structurally ambitious model, and, understanding it is really key to understanding the future of digital asset treasuries.
That structural ambition is the core conflict you need to grasp. Our deep dive today centers on a thesis that captures the immense high-stakes trade-off Strive is making.
Okay, let's hear it.
Strive, ASST, is an attractive investment due to its aggressive plan to become a Bitcoin-era Berkshire Hathaway by leveraging Vivek Ramaswamy's 58% voting control to consolidate assets to over 10,900 Bitcoin. But this value creation hinges entirely on the success of its proprietary alpha strategies and the mitigation of regulatory and accounting volatility risk associated with the business model.
Okay, a Bitcoin-era Berkshire Hathaway, that is a bold claim. Let's unpack this blueprint, and I think we have to start with the bedrock governance.
It's the only place to start.
When you look at Strive, you aren't looking at a typical public company. The absolute concentration of power is, I think, the single most critical component here, because it dictates the speed and efficiency with which they can execute this whole strategy.
It's the engine of the whole operation. Strive is built on a dual-class share structure, and it's specifically designed to centralize power while still accessing public market capital.
So how does that work exactly?
They offer Class B shares, which carry a formidable 10 votes per share, alongside the common Class A shares, which carry just 1 vote.
10 votes to 1. So that means a relatively small equity stake can translate into overwhelming control.
Precisely. And when we actually quantify that control, it becomes startlingly clear why this is categorized as a high-control structure.
What are the numbers?
Vivek Ramaswamy, along with his affiliated entities, holds a colossal 58.46% of the total voting power.
Over half. So he has unilateral control.
He does. And that percentage isn't just a number. It is a structural designation. Because the voting power is concentrated above that 50% threshold, Strive qualifies as a controlled company under NASDAQ listing rules.
Let's pause on that controlled company designation, because for you, the investor, it means Strive operates under a completely different rule book than, say, a traditional corporation. What are the practical implications of that?
The practical implications are radical centralization and streamlined decision-making. Since they are controlled, Strive can rely on critical exemptions from standard corporate governance rules.
Like what, specifically?
For example, they are exempt from needing a board composed of a majority of independent directors. They also don't need fully independent compensation committees or nominating and governance committees.
So the usual checks and balances that shareholders expect, they're just not there.
They're not required to be. In essence, nearly 60% of the voting power means Ramaswamy's vision can be implemented immediately, without the friction, the debate, or the potential proxy battles that slow down the management of most publicly traded firms. This centralization is the key structural feature enabling their rapid M&A strategy.
And the recent acquisition of Semler Scientific is the perfect test case for this streamlined, centralized governance model.
Absolutely. The Sort's documents reveal how he leveraged this voting concentration to execute the deal with, frankly, unmatched speed, sidestepping the whole protracted shareholder voting process.
How did they do it so fast?
They employed a mechanism known as the Strive written consent.
The written consent.
Right. Since Ramaswamy commands the majority voting bloc, he simply needed to sign a written consent to approve the merger with Semler Scientific SEI. That's it.
So no need for a full shareholder meeting, no waiting period for votes.
No need for any of it. No further action required from the common stockholders. When you're pursuing acquisition targets, particularly ones that might be undervalued or sensitive to public market scrutiny, this ability to execute M&A instantaneously, it's a core competitive advantage.
It's governance optimized for opportunistic asset accumulation.
That's a perfect way to put it.
And speaking of opportunism, the economics of the Semler acquisition are a masterclass in using premium valued stock as currency.
Oh, absolutely. Strive is essentially weaponizing its valuation premium to acquire an asset-rich company that's trading at a significant discount.
So let's get into the numbers on that, because this is where the immediate value creation is supposed to happen.
Okay, so Strive, AST, is trading at a high multiple, specifically 4.14x NAV, or net asset value. This premium reflects the market's belief in the long-term vision, the control, and the promise of that Generation 2 strategy we talked about.
So the market is paying over $4 for every $1 of assets on their books.
Right. And they are using this highly priced equity as currency to acquire Semler Scientific, SEI, which comparatively is trading low at just 0.96x NAV.
So they're buying a company that's trading for less than its assets are worth. That valuation arbitrage is enormous. How does the structure of the deal actually capture that differential?
The mechanism is a fixed exchange ratio. For every 1 share of Semler, the holders will receive 21.05 AST shares.
A fixed ratio.
Yes. So by executing this trade, Strive is instantaneously capturing that value gap between its premium valuation and Semler's discounted valuation. This acquisition immediately reinforces that core ambition of becoming a Bitcoin-era Berkshire Hathaway, using market confidence, your premium stock, to consolidate discounted assets into a central holding vehicle.
And the immediate tangible result of all this complex governance and financial engineering is just scale.
It is. This merger isn't just about the arbitrage. It's about vaulting Strive into a dominant tier of corporate Bitcoin holders, basically overnight.
So what's the final count look like?
The scale is the ultimate objective. We'll get into their starting number later, but when you combine the projected assets of Strive and Semler post-merger, the total Bitcoin holdings are projected to be over 10,900 Bitcoin.
Over 10,000. That's a serious number.
It's a critical volume. It immediately scales Strive into a dominant position among publicly traded corporate Bitcoin holders, realizing that core vision. This sheer size is intended to attract deeper institutional interest and further validate the thesis that centralized, actively managed treasuries are superior.
That brings us to the operational engine. All that control and all those assets mean nothing if the company can't afford to keep them or, grow them. So let's shift gears and look at the engine room. What defines success for this rapidly expanding entity? And how do they plan on fueling their growth without liquidating that core treasury?
Okay, so first, we need to address the definition of success, which is enshrined in their capital allocation policy through what they call the hurdle rate.
The hurdle rate.
This is the single most important metric driving their operations. Strive's mandate dictates that the hurdle rate for all new capital investments, whether it's M&A activity, strategic partnerships, or these proprietary alpha strategies, must be the expected appreciation of spot Bitcoin.
Wow. That is an incredibly disciplined mandate. It means they have zero tolerance for any capital deployment that underperforms the simplest, most passive strategy, which is just holding Bitcoin.
That's it.
So if they put $100 million into an investment and Bitcoin gains 20% that year, that investment must return more than 20% just to be considered successful.
Exactly. It completely changes the risk calculation. They aren't trying to beat the S&P 500. They are actively seeking outperformance against the hardest asset class available.
Which means the complex structure, the governance, the cash flow engine, it's only justified if it can prove year after year that it can generate incremental Bitcoin above the performance of just holding it.
Above the performance of those passive Generation 1 corporate holding models. That's the whole bet.
Okay, so if that is the standard for investment, we have to ask what provides the actual fuel to execute these high-hurdle strategies and service their existing debt. And that's where the acquisition of Semler Scientific healthcare diagnostics company starts to make some complex, if counterintuitive, financial sense.
It is counterintuitive on the surface, but the acquisition of Semler, despite its operational challenges, is explicitly designed to provide a much-needed, non-Bitcoin-related cash flow engine.
Fiat cash flow.
Exactly.
Yeah.
Strive is a growth entity with significant debt obligations, and they need a consistent stream of fiat revenue. Semler's core business revolves around its QuantaFlo vascular testing product.
Right.
This product operates on a recurring revenue model, primarily leasing equipment and charging a fee per test, generating consistent income from healthcare providers. And that QuantaFlo testing accounts for the vast majority of Semler's revenues.
This recurring revenue stream is absolutely vital, but We can't ignore the baggage Strive is inheriting here. Semler is not a company that's operating at peak efficiency. In fact, the documents point to some severe operational headwinds.
That is the critical risk element they're absorbing. Strive is trading the risk of having to sell Bitcoin for the risk of operational liability. And we have to note that Semler experienced a massive 44% revenue decline in the year ended December 31st, 2024, compared to the prior year.
44%? That's a staggering drop. What happened?
The decline is largely attributable to the complex and shifting landscape of healthcare reimbursement, particularly changes related to Medicare Advantage risk adjustment rules.
So a regulatory shift in healthcare basically kneecapped their revenue. But the inherited baggage goes even deeper than that, doesn't it? There's a regulatory scar on the balance sheet that speaks to some historical business practices.
Yes, the filing details that Semler was subject to a significant $29.8 million settlement agreement with the Department of Justice, right, related to a qui tam action under the False Claims Act. Now, for the listener who might not be familiar, a qui tam action is essentially a lawsuit brought by a private citizen, or relator, on behalf of the government, alleging fraud against the government.
And what was the allegation here?
This specific settlement concerned the promotion of the QuantaFlo device, suggesting historical issues regarding the claims made about the product's utilization and effectiveness within the federal healthcare system.
So Strive is essentially acquiring a patient that is bleeding and requires immediate triage. But despite these challenges, the financial necessity of this compromised revenue stream is paramount, especially given Strive's debt profile.
Absolutely. The goal is to ring-fence the Bitcoin treasury. Strive has considerable corporate debt obligations that must be managed without resorting to selling the core digital asset.
What kind of debt are we talking about?
These obligations include a substantial $20.0 million Coinbase loan, which is collateralized by some of their Bitcoin, and a large $100.0 million aggregate principal amount of convertible senior notes due in 2030.
So you've got over $100 million in debt that needs servicing.
Right. So having Semler's steady, fee-based revenue stream, even one suffering from a 44% decline, provides the critical liquidity required to cover debt servicing, fund daily operations, and pursue those ambitious alpha strategies without ever having to liquidate the core 10,900 Bitcoin treasury. That non-dilutive operational funding tap is the entire point of the Semler acquisition.
Which seamlessly leads us into the third pillar of this whole thesis, this sophisticated financial engineering designed to fund this rapid growth. Strive needed capital, $500 million to be exact, but they couldn't just issue common stock.
The ASST stock.
Right, they couldn't issue AST without risking the dilution of Vivek Ramaswamy's precious 58.46% voting control. So they created a novel, non-voting funding mechanism.
This is where the structural complexity shifts into high gear, but it is undeniably ingenious financial architecture. They introduced two fundamentally different instruments to appeal to two different classes of investors.
Okay, let's break them down.
First, you have AST, the Class A common stock, which is the beta exposure. If you buy AST, you are buying the volatile, long-term exposure to the Bitcoin treasury and capital appreciation.
And then they created the SATA, or Series A perpetual preferred stock. I like to think of this as a turbocharged corporate bond disguised as equity.
That's a great analogy. SATA is the senior yield instrument. It's designed specifically to attract non-beta seeking capital investors who prioritize yield and asset seniority over the volatility of digital asset price appreciation.
And the terms are designed to be very attractive for that kind of investor.
Highly attractive. For those seeking high, reliable payments, SATA pays a generous 12% cumulative dividend.
12% is massive in today's environment. For a listener, what does cumulative mean in this context, and what happens if Strive struggles to make those payments?
The term cumulative is vital. It means that the company is obligated to pay these dividends, and if they miss a payment, that obligation doesn't disappear, it just accrues, it piles up.
So they have to make it up later.
They do. And if Strive were to fail to pay the dividend for a certain period, that failure would trigger specific protective provisions for the preferred stockholders, which could even include the right to elect preferred stock directors. This seniority places a considerable ongoing financial burden on the company, protecting the SATA investor while ensuring management stays highly disciplined.
And the scale of this funding tap is enormous, which really demonstrates their reliance on this instrument.
They are executing a $500 million SATA ATM offering.
ATM being at the market.
Exactly. An ATM offering allows the company to continuously issue shares directly into the market over time. And crucially, as we established, these SATA shares are non-voting on most matters. This structure is the key to the whole financial plan. Strive is raising $500 million while completely preserving Ramaswamy's 58% majority control.
This kind of financing model requires active, almost real-time management. The sources show they don't just let the stock float, they actively manage the price of the preferred shares to maintain that flow of yield-seeking capital.
It's a delicate high-wire balancing act. Strive actively manages the pricing, with the stated intent to maintain trading between $95 and $105 per share.
Why that specific tight window?
Well, the $100 per share is the stated amount, and $110 is the cap on the liquidation preference adjustment that's defined in the legal documents. By keeping the price within this narrow range, they assure a continuous flow of capital.
Because if the price spikes too high,
The yield drops, scaring away the yield-focused investors, and if it dips too low, it signals distress. This active pegging maintains the liquidity and attractiveness of this critical funding mechanism.
Okay, let's discuss the critical trade-off here. While SATA preserves voting control, it introduces significant dilution risk for the common shareholders, you, the AST holder.
The common shareholder is absolutely absorbing the seniority risk. Because SATA is senior, in the event of liquidation, SATA has preference.
They get paid first.
First, $100 per share plus any accrued accumulated dividends must be paid out before the common equity sees a penny. This significantly dilutes the common shareholder's residual asset claim.
But management has a strategy to try and mollify that asset dilution risk, right?
They do.
Yeah.
And it involves using the capital raised by the preferred stock to buy back the common stock.
So they're taking with one hand and giving back with the other.
In a way, the source material notes that proceeds from the SATA offering may be used for an AST repurchase program, authorized up to $500 million. This is a direct measure intended to offset the dilution risk to common shareholders by reducing the outstanding share count.
It's a very calculated financial maneuver.
It is. It's designed to thread the needle, fund growth non-dilutively to voting control, but then use some of the proceeds to reduce the common share count and mitigate the asset claim dilution.
We've established the structure, the funding, and the operational cash engine. Now, we arrive at the core argument for why this massive complexity is even justified: the alpha strategy. If the hurdle rate is set at spot Bitcoin appreciation, Strive must have mechanisms in place to consistently exceed that rate. This is the promised outperformance, the Generation 2 thesis in action.
This is where Strive attempts to differentiate itself permanently from every passive Bitcoin ETP on the market. They are promising active management that delivers Bitcoin accumulation beyond simple price movements. They have outlined 3 core alpha streams: proprietary methods that leverage financial, legal, and operational expertise.
Okay, let's start with the first one. It sounds highly specialized and, frankly, aggressive distressed litigation.
The first stream is acquiring distressed Bitcoin litigation claims. Think of all the bankruptcies, insolvencies, and regulatory crackdowns that have tied up billions of dollars worth of Bitcoin in the crypto ecosystem.
All that frozen capital.
Exactly. Strive aims to purchase the rights to these Bitcoin claims, the legal claim on the asset, at a significant discount to the current spot value. For example, they might buy a claim on 100 BTC for the price equivalent of 70 BTC. The alpha generated is the difference between that deeply discounted purchase price and the eventual recovery of the full 100 BTC once the lengthy legal or bankruptcy proceedings are resolved.
It's classic distressed debt investing, just applied to digital assets, leveraging specialized legal expertise.
That's precisely what it is.
Okay, that introduces risk and illiquidity, but the potential spread is compelling. What about the second stream? This involves getting into the complex world of structured credit.
The second method involves investing in junior tranches of Bitcoin-backed credit structures. Traditional lending products offer different layers of risk. You have senior debt, mezzanine, and junior equity or tranches. If you want high yield, you move down the stack.
And you take on more risk.
Strive intends to position itself in the riskiest, highest-yielding portions of crypto lending products. The source documents mention market examples like platforms or structured funds, things like Salt Shield or Leadin. By taking on that subordinated risk, they receive higher compensation, a yield that must be paid in incremental Bitcoin.
So this generates an accumulation yield over and above just passively holding the asset, but it also means they're lending out some of their treasury or capital, which runs contrary to the passive hold strategy. It's a highly aggressive use of capital.
It is, and the risk is clear. If the underlying collateralization fails, they are the first to suffer losses. But if it's successful, they gain Bitcoin yield.
Okay. And the third alpha stream.
The third and final alpha stream is one we've already discussed, but it's formalized as a key pillar,
Mhm.
M&A arbitrage.
And that, of course, is the Semler play in generalized form.
It's exactly. This involves strategic acquisitions of discounted cash flow or assets. The Semler Scientific acquisition perfectly demonstrates this. Acquiring an operating company at a discount relative to its net asset value or intrinsic value, or acquiring one whose specific, non-volatile cash flows can be immediately directed into accumulating more Bitcoin. The goal is to continuously convert undervalued traditional or legal assets into growing digital assets.
Okay, so before we turn to the risks that could structurally impair this entire ambitious model, we need to ensure this isn't just theory. We need to correlate these ambitions directly back to the sources, the financial filings, to confirm the foundations are solid. Time for our source correlation check.
Let's start with the hard numbers on the Bitcoin treasury itself, confirming their starting point before the merger. Filings confirm Strive's historical and current Bitcoin count is calculated as 7,525 BTC.
7,525.
Right. And this figure breaks down into the two previous major holdings the company accumulated. 5,886 BTC plus another 1,639 BTC. This confirms they had a significant treasury built through prior capital deployments, giving them the scale they are now nearly doubling with the Semler acquisition, aiming for that 10,900 BTC target.
Okay, so the base number checks out. Next, let's verify the financial engineering, the heart of the funding model. We talked about the active management of the SATA preferred stock price. Does the legal documentation actually confirm the mechanics they intend to use to maintain that trading range?
It does, and this is crucial validation. The legal terms directly support the intended maintenance of the trading price between $95 and $105 per share.
Yeah.
This range perfectly matches the underlying financial structure.
Host.
The preferred stock has a stated amount of $100 per share, and the liquidation preference adjustment is legally capped at $110 per share. This corroboration validates that the financial engineering component is precise and legally mandated. They have structured the instrument to behave exactly as they intend, attracting capital consistently through that actively managed funding tap.
We've established the massive scale, the centralized control, the complex funding mechanisms, and the highly specific alpha strategy designed to beat the market. Now let's transition to the final verdict, balancing this high-reward structure with the major non-financial threats that could structurally impair the entire business model.
The investment case for Strive is, I'd argue, the most complex and high-conviction thesis in the digital asset space today. You get massive scale, a path to over 10,900 BTC, coupled with highly centralized decisive leadership.
And that brilliant financial structure.
It is brilliant. The SATA non-voting mechanism provides crucial funding without sacrificing control. And the Semler cash flow engine provides the fiat currency required to service debt and fund operations without selling the core treasury. The entire model is designed for aggressive asset accumulation and engineered outperformance.
But the structural challenge remains. Is this incredible complexity justified by the potential alpha, or does the model remain a high-risk bet due to significant structural, non-financial threats that lie completely outside the company's operational control? This is where the thesis breaks down for those who are highly risk-averse.
It is undeniably a high-risk scenario, and these risks are not standard operational concerns. They are existential structural threats. The first major threat is pervasive regulatory risk, specifically centered on the potential reclassification of Bitcoin by U.S. regulators.
Right. We know that currently the IRS treats Bitcoin as property, which is foundational to Strive's entire operating model as a corporate treasury holder.
But if the regulatory winds shift, and this is a constant threat in the crypto space, and the SEC reclassifies Bitcoin as a security, Strive could potentially be forced into the restrictive compliance framework of the Investment Company Act of 1940.
The 40 Act.
The 40 Act. It places severe limitations on companies whose primary assets are classified as securities. If Strive were designated an investment company under that act, it would impose restrictions on their capital structure, their leverage, their ability to conduct M&A arbitrage, and potentially their ability to execute many of their proprietary alpha strategies, like investing in junior tranches or distressed claims.
That would essentially be an existential threat. It would force them to unwind or radically change their sophisticated business model. The controlled company status, the written consent, all of it would become worthless if the core business activity is regulated out of existence.
Absolutely. The 40 Act threat is the single biggest policy sword hanging over Strive. And on top of that, the second major structural threat is already visible on their P&L, accounting volatility.
Which is unavoidable for any publicly traded company holding a large, volatile digital assets.
Right, and this relates to the recent change in accounting standards, which seems minor on the surface but has massive implications for net income reporting.
What's the change?
It's highly technical but critically important. Under the new standard, ASU 2023-08, Strive is now required to remeasure its entire Bitcoin holdings at fair value at the end of each reporting period. And here's the key change. All unrealized changes in that fair value, whether gains or losses, must flow directly through net income.
So if the price of Bitcoin surges, Strive reports a massive non-cash gain, and they look wildly profitable. But if the price of Bitcoin dips, they report an equally massive non-cash loss, looking utterly catastrophic, even if they haven't sold a single coin.
Exactly. This guarantees extreme non-cash earnings volatility. We already saw the immediate impact in a recent reporting period. The combined effects of a massive $140.8 million goodwill impairment and $24.9 million net investment losses driven largely by market fluctuations contributed directly to a severe $192.3 million net loss.
A nearly $200 million loss on paper.
On paper. And while a vast majority of that is non-cash accounting noise, that level of earnings volatility can utterly confuse generalist investors, increase compliance scrutiny, and continuously put downward pressure on the stock price, regardless of the long-term Bitcoin accumulation trend. It's the inherent cost of placing a volatile digital asset into a traditional corporate accounting wrapper. Ultimately, the Strive thesis represents Generation 2, a highly sophisticated, high-control attempt to permanently outperform passive accumulation. They are betting that centralized power, complex financial engineering, and proprietary alpha streams can consistently beat the simplest strategy, just holding spot Bitcoin. The critical question for you, the discerning investor, is whether the potential incremental outperformance of a few percentage points of alpha truly justifies the immense complexity and the inherent structural and regulatory risks they have built into the entire framework.
A question that forces you to define your tolerance for volatility, driven not by operations, but by regulatory decisions and accounting standards. Risk defined, portfolio protected.